Good day, everyone. We hope you're all having a pleasant week. Welcome to our video for the Finance Fast Talk. We're the group who will be discussing crowdfunding and microfinance. But first of all, what is crowdfunding? Crowdfunding can be defined as the use of small amounts of capital from a large number of individuals to finance a new business venture or financial project. Specifically, these said individuals are often completely unrelated to or unaffiliated with the handler of the project that they are planning to invest in. This particular structure of project funding has actually existed for far longer than one might expect, with notable instances even long before the culmination of the internet. Looking at the history of crowdfunding, it can actually be traced back all the way to 1730, the first known significant instance of a funding mechanism very similar to the definition of crowdfunding today. In the early 18th century, Alexander Pope was known to have taken advanced subscriptions to the end product of his work, which at the time was the English translation of the originally Greek literary piece Homer's Iliad. Fast forward to the 19th century, another historically renowned instance of the use of crowdfunding was towards the construction of the famed Statue of Liberty. Publisher Joseph Pulitzer utilized his popular newspaper, the New York World, to publicize a fundraising campaign for the assembly of the parts of the statue. Thanks to his help, this campaign ultimately raised a total of $100,000 from a total of 160,000 donors, which had gone on to make the construction a success. In 1997, the British rock band Marillion was credited with being the subject of the very first recorded instance of a successful crowdfunding campaign that utilized the power of the internet. Thanks to campaign organizer and rock fan Jeff Pelletier, many US fans were able to donate up to $60,000 to help fund Marillion's reunion tour to the US. As a result, in the following years, numerous different places on the internet have also begun to take notice of the significance and power of crowdfunding to help get the projects to take off. ArtistShare, the first recognizable fan funding platform, was launched in 2001. Its primary advocacy was to help connect music fans with music producers and artists to help the artists fund the projects and resources needed to release their albums online. Next, two of the biggest crowdfunding websites, Indiegogo and Kickstarter, launched in 2008 and 2009 respectively. Since then, crowdfunding has continuously gained traction in the business world, with crowdfunding revenue tripling in value from $530 million in 2009 to $1.5 billion in 2011. It has only continued to rise ever since, eventually becoming an internet staple, even boasting a 74% compounded annual growth rate. Considering how limited our funding options are right now, crowdfunding has made itself very appealing to those who possess great potential to start a very successful business, but have limited financial capabilities to realistically push through with it. Generally, the organizer of the subject of a crowdfunding initiative can range wildly from corporate arms to popular artists and prominent figures in media to social welfare organizations, student groups, small businesses, or even a single person. Meanwhile, the funders or backers of such ventures are usually composed of unaffiliated strangers who put their money and trust in the potential success of the project in question, with sometimes little more than only the crowdfunding platform policies to help ensure the returns of a few benefits from their participation, if any at all. For many people who are active on social media, they will soon come to learn that while the general structure of crowdfunders are quite similar, there actually exists a multitude of different methods in which this structure can be applied.
So there are actually 5 types of crowdfunding. The first one being donation-based. Donation-based crowdfunding works essentially how it sounds. It utilizes crowdfunding with a donation system, often towards causes of social welfare or private health emergencies related to the organizing party. So it doesn't technically have to be for a good cause, so to speak. The defining characteristic of these kinds of crowdfunders is that it sports very little to no investor benefits other than the updates on the situation of the project. At the same time, the amount that they wish to donate will solely be up to the investor, which is why this is a very popular option for donation drives. It holds no limitations with regards to the amount, so as long as the investor is willing to donate it. Second type of crowdfunding is the reward base. This type of crowdfunding is probably the most popular imagery that people think of when they imagine crowdfunding projects. We can mostly see this type of crowdfunding for projects on the popular crowdfunding platforms like GoFundMe and Kickstarter. This type is defined by the reward system or rewards ladder offered by each asking project. A rewards ladder is sort of like a donation goal wherein the investors of the project receive certain rewards and benefits which increase in value proportionate to the amount that they donate. These benefits can range from things such as handmade items, sponsored products, free samples of the project, art pieces, collectibles, etc. This kind of crowdfunding is mostly done by small indie businesses or upstarts, but there are also rare occurrences of successful projects by non-professionals or hobbyists that follow this pattern. third type of crowdfunding is known as the equity crowdfunding. This is also referred to as crowd investing, investment crowdfunding, and crowd equity. This type is considered to be the best choice for small to medium-sized companies that are seeking a large sum of money for the purposes of either launching or expanding their businesses. A little similar to rewards-based crowdfunding, equity crowdfunding offers percentage ownerships of their company to donors proportionate to the amount of money they donated. However, due to the nature of this exchange, equity crowdfunding is notorious for having very large donation minimums, which vary from business to businesses. The fourth type is known to be debt crowdfunding. This is also known as crowd lending and is a very fast, easy, and probably the simplest way in crowdfunding for both parties in the transaction to focus on a single straightforward monetary and financial goal. Debt crowdfunding works by collecting donations with the promise to investors of returning these back with returns at a later date with an additional interest to be given to the investors. Just like equity crowdfunding, this type of crowdfunding is more popular with businesses that need capital but are not inclined to hand out equity, though individuals are able to utilize such as well for the purpose of paying back large and fast-growing debts. And lastly, we have the real estate crowdfunding. This type of model is recently becoming more popular, especially for investors who want to put all their money into real estate without need for a traditional loan or the pressure of owning a single property. Similar to equity crowdfunding, but specifically for real estate investors, willing participants can own parts of the property depending on the amount that they are willing to fund. They will then receive payouts each quarter with the amount dependent on how much revenue the property they invested in generates. Now, knowing these 5 types of crowdfunding, we may look at the next side of finance, which is also known as microfinance.
First, what is microfinance? Microfinance is a banking service provided to unemployed or low-income individuals or groups who otherwise have no other access to financial services. Microfinance allows people to take on reasonable small business loans safely and in a manner that is consistent with ethical lending practices. So just a brief history about microfinance. Its concept has been long existing since the 18th century when Lysander Spooner wrote about the benefits of small loans to entrepreneurs and farmers as a way of getting people out of poverty. During the 1970s, Jonathan Swift introduced the Irish Loan Fund system, which provides microlending services to help improve the living conditions of impoverished citizens. In Bangladesh, Dr. Muhammad Yunus observed that moneylenders are controlling the residents because of accumulating debts. Thus, in 1983, he established Grameen Bank to provide microcredit loans to the poor without requiring collaterals. Grameen Bank expanded to more than 80,000 villages and more than 6 million borrowers. In 1990, the industry began to restructure upon realizing that it could not grow at such rates while relying on grant funding. Hence, more formal business practices were adopted to improve efficiency and sustainability. In 1998, India's SKS Microfinance, a company patterned to Grameen Bank, was formed. Eventually, it became one of the biggest microfinance operations in the world. During the same year, Positive Planet, an international NGO, was formed with a mission to fight poverty by developing microfinance. In the Philippines, microfinance started as a social development initiative to alleviate poverty. In 1993, a presidential task force on credit for the poor was formed to create a master plan containing 3 main strategies to alleviate poverty through microfinance, which are policy reform, financial resource mobilization, and capability building. In 1999, Microfinance Council of the Philippines Incorporated was registered with SEC as a non-stock corporation. MCPI is the national network of microfinance institutions working towards sustainable, innovative, and client-responsive solutions to poverty in the country. In 2004, it merged with the Philippine Network for Helping the Hardcore Poor, a microfinance association focused on Grameen replicators in the Philippines. Currently, its regular members include 26 NGOs, 13 banks, 6 cooperatives, and 2 regional networks. But how does microfinance work exactly? Microfinance helps the financially marginalized by providing them with the necessary capital to start a business and work towards financial independence. The term microfinance encompasses microloans, microsavings, and microinsurance. As said earlier, microfinance institutions provide smaller loans and other resources to business owners and entrepreneurs to help them get their business off the ground. These microloans are significant because they are given enough even though the borrower has no collateral. However, the interest rates for these microloans are often high due to the risk of default. Savings accounts are under the microfinance umbrella. They allow entrepreneurs to have saving accounts with no minimum balance. Microinsurance provides these borrowers with insurance at a lower rate and with lesser premiums.
Let's now take a look at the advantages and disadvantages of microfinance. For its advantages, first, most microfinance companies require no collateral upon issuing microcredit loans, making it accessible to people with lower socioeconomic backgrounds. Second, it helps people meet their financial needs by providing them easy financial credit. Third, microfinance companies can disburse quick loans under urgency, thereby helping individuals during emergency situations. These include housing loans, business loans, and working capital loans. Lastly, it helps encourage entrepreneurial activities and business development. As for the disadvantages, microfinance companies usually offer smaller loan amounts and these often entail high interest rates. Also, only few microfinance institutions provide formal business training to empower their borrowers who are about to embark in their entrepreneurial venture. You might be thinking, for whom microfinance is suitable? Microfinance services are suitable to unemployed or low income individuals who have limited financial resources or do not have enough income to do business with traditional financial institutions. Although they exist all around the world, the majority of microfinancing operations occurs in developing nations such as Uganda, Indonesia, Serbia, and Honduras. Many microfinance institutions focus on helping women in particular. Microfinancing organizations also support large number of activities that range from providing the basics, like bank checking and savings account, to startup capital for business entrepreneurs and educational programs that teaches the principles of investing. These programs can focus on such skills such as bookkeeping, cash flow management, and technical or professional skills like accounting. So, to sum it all up, crowdfunding and microfinancing can seem to have very similar structures on paper. Their primary difference lies in the direction which the money is flowing towards. Where crowdfunding works through individual businesses attracting investments from a larger audience, loans from microfinancing institutions are actually sought after by multiple business owners. Both structures put the lenders at risk if the project bombs, but whereas the returns from microfunding are always monetary, returns from crowdfunding can also include products or even no returns at all, depending on the type. So that ends our presentation. We hope you learned a lot from crowdfunding and microfinancing. Thank you for listening.